Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JESSEDAY to get a $10 discount on your first purchase. Today's guest is the CEO of Cambridge House and the host of The Jay Martin Show, where he discusses investing for personal sovereignty. My good friend, Jay Martin, it's great to have you on the show.
It's great to be here, Jesse. I'm looking forward to it.
Yeah, we've been hoping to do this for a while, so happy we were able to make it come together. And as you are a new guest on the show, we always start with the origin story. So, how did you first discover investing? How did that road lead you to where you are today and coming up with the concept of investing for personal sovereignty?
So I think I don't know what age, but very early, I always had a huge appetite for geopolitics in an odd way. And I can recall being maybe 14 or 15 years old and tearing apart the morning paper when, one specific event. I recall when Hugo Chavez won the first election that he won in Venezuela, and what a disruption this was, and sort of the big transition in Venezuela towards a more socialist country. And it, really found myself like clinging to what all this meant, right? And then gravitating towards similar stories around the world because the content just pulled me in. And if you go down that rabbit hole far enough for long enough, um, you find yourself surrounded by the stories of power, right? Why is power distributed the way it is around the globe? How does power shift? Why does power shift? And what are the different styles of power that leaders impose upon their citizens, and why? And what are the outcomes of those different styles, and all of this stuff? And being like a pretty simple human being, I like to really minimize things to the fundamentals, right? Get really like sports specific with the topics I'm trying to understand, if you will, and get down to real basics. And the real basics of geopolitics, from my perspective, there's really two things at play. There's human nature, which is understanding the psychology of human beings and the psychology of decision making, behavioral economics type of stuff. And the second would be the raw materials that those humans have access to leverage, right? So what can they put their hands on, either within their country or outside, that they have access to? And those are the building blocks for really everything else that exists, as far as I understand the world. It's humans and how we are with ourselves and how we are with each other, and then what we have access to build with, right? And on top of that, we build, economies, currencies, technologies, and relationships, and all of this stuff. But it gets down to those core principles, which is a nice little segue into understanding the supply and demand of those raw materials, which is the commodities market, which is my core focus as an investor, and still is today, right? I don't just limit myself to commodity investing anymore. I'm super active in a couple other sectors, but it is a huge chunk of my portfolio still today. And I still love it, man, as much as I used to. Like, I still love the narratives and the stories, and understanding the world through story just makes it the best novel you could ever read. And it's a really fun journey, to be honest.
And how does investing help someone to gain personal sovereignty, in your view?
So if you look at the pursuit of wealth creation as a very noble cause, which I encourage people to do so, I think we're often sold this story at a young age that, pursuit of money is evil and it's not a worthy way to spend your life. And, do what you love, don't worry about the money, all this stuff. Now, there's some truth in that for sure, but it comes at the cost of people vilifying wealth creation, which is a huge, huge mistake, because you're either independent or dependent in this world. You're either relying on somebody else, or you're somebody that people can rely on, right? And creating personal wealth gives you, it doesn't make you happy. You can't buy happiness, but wealth does buy you options, and it can help solve problems, and it can put you in a position to be the rock that somebody else needs to lean on. And the world needs more rocks. That's what I believe. You could pursue the creation of wealth and do none of those things and help nobody, and that's your choice. But you don't have that choice unless you create the wealth first. And so I like to emancipate myself as much as possible from the poor decisions of others, from counterparty risk that's outside of my control. And one way to do that is through wealth creation. And the smartest way to do that, in my opinion, is through capital gains. You will. I don't believe you can achieve as much wealth in as expeditious a way through salaries and building businesses, which I do and whatnot. But the biggest wins in my financial life have all come from capital gains. Most of the wealthiest individuals I know have built their wealth through capital gains. And so putting your cash to work, like, don't neglect cash flow, work hard, generate cash flow. It's very important and actually not respected enough. But, on top of that, put that cash to work and build yourself as Frank in The Gambler, the movie with Mark Wahlberg and John Goodman's playing playing this character. They're sitting down at a table, and he's like, Wahlberg's like, I've been up $2 million. And Goodman says, how much do you have left? And he goes, nothing. He goes, what'd you put away? Nothing. And then he goes on this tangent. And he goes, you get up $2 million. Any idiot knows what to do, right? And he goes into the concept of FU money, right? Where you buy the house, you put the cash aside to make sure you're in a position of FU for the rest of your life, because you've got that treasury, right? That allows you the optionality to choose whether you want to do this or want to do that. And you're not in a position of being dependent, back to that, where you have to do things that you don't want to do because, you don't have the optionality that wealth provides you.
Yeah, that makes perfect sense. And speaking of, you spoke there about getting away from counterparty risk. I know you're a big advocate, at least for yourself personally, when it comes to holding physical gold and silver. I've heard you discuss it a lot on your show. So talk to us about the main reasons you think holding physical precious metals is important.
Yeah, there's two main reasons for me. One of them is that it is the only asset, one of very few assets, that has little to no counterparty risk. So the counterparty risk, just real simple, is whoever's holding the other side of your bet, right? Essentially. So if I'm investing in Tesla, as an example, Elon Musk is my counterparty risk. I could believe in the mission behind Tesla and the demand for the cars and all this stuff, but Elon could do something remarkably stupid tomorrow and crash the share price and compromise my purchasing power that I had stored in shares of Tesla stock. So Elon Musk is my counterparty risk. When you're holding fiat currency, like the almighty dollar, the counterparty risk is whoever's distributing that currency, right? So the issuing body who's distributing or not distributing that currency compromises the purchasing power of that asset. So my fiat currency, the counterparty risk is, in my case, the Canadian government, who may issue, eye-watering amount of new currency with seemingly no end, devaluing the purchasing power and compromising the value of that asset. So in the case of fiat currency, it's the governing body typically that is the counterparty risk. So every asset typically has somebody on the other end who can compromise the value of that asset, and it's outside of your control, except for a few, gold being one, and gold being the simplest. So I own gold for that reason. It's a sovereign store of wealth, meaning it's emancipated from the poor decisions of others, and it gives me confidence, Jesse. So storing wealth in gold for me is like, it's basic, boring savings. I get it. It does not generate yield. It's not a volatile asset most of the time. So I'm not holding gold for capital gain. I'm holding it to retain my purchasing power. And it's supposed to be boring. It's supposed to be a pet rock, by the way. People sort of shit on it and say, oh, gold's just a pet rock. It's like, yeah, that's the point, right? Like, safe haven wealth should not be volatile. That's what you want from it. You want over time to make sure you still have as much purchasing power as you used to. And I think in like 1925, you could buy a luxury men's suit for about an ounce of gold. And today you can buy a luxury suit for an ounce of gold, just for some context there. And so by holding my savings in physical gold, I'm confident that I've retained my purchasing power, and the value will be there as it was yesterday and all this stuff. Now, I can't predict what the future holds, right? So I don't know what's around the corner and multi-year trends in wealth and all this stuff. I can make some assumptions, but so people often gravitate towards Bitcoin these days as a replacement for gold. And by the way, I own a lot of Bitcoin as well. But for maybe different reasons. I think that you got to give, nothing stresses an idea better than time, and proves its validity better than time. And so Bitcoin may turn into something like that, 10, 20 years, 30 years, 100 years down the road, but it's got to be given that opportunity. And it just hasn't, since 2008, whatever, been given the real opportunity, the real stress test, which is the rise and fall of currencies, the rise and fall of empires. And gold has, right? You can look through hundreds of years of history and you'll see that same trend that gold retains its purchasing power. Over the last 600 years, we've had 5 empires, beginning with the Portuguese, and the Spanish, the Dutch, the British. We're now in the American Empire. Gold has retained its purchasing power and its store of value properties throughout, going back to the Roman Empire. You can go further. You can go thousands of years and you'll see this, right? And so that just gives me the confidence that it's still a safe bet today, right? And I don't know, how the world will evolve, what will change, and maybe, sure, some other assets will step forward and play that role as well. But all I can do is look at the past and say, well, what's worked, through periods where the world changed more than anybody believed it ever could. When you're living inside the global superpower, the dominant empire with the world reserve currency, as the citizens of all those countries I just mentioned were, I guarantee you, most of them could never imagine that scenario, that era would ever come to an end. Just like most Americans can probably not believe that the American empire will come to an end, right? But it will. This is guaranteed. And so during those transitions in history where nobody could imagine the world would change as it did, there's a couple common denominators, right? Property being one, if property rights are respected, gold being another, right? And so for that reason, I do appreciate physical gold.
And let's switch from the physical to the mining equities. Obviously, this is a far more speculative part of the market, which does have counterparty risk. But how do you view the gold and silver stocks at this point in time? And how do you view the stocks versus the physical metal? And let me know, at the moment, are you deploying capital when it comes to that sector? Are you sitting on the sidelines? What are your what's your approach there?
So I am deploying capital right now into certain high quality gold producing, cash flow positive gold mining companies. The reason, Jesse, is not that I think that sector is going to pop, in the next 3 months or 6 months, 9 months. I don't know. I can't time markets, but I can look at companies and decide when they're cheap. And my mission as an investor is not to time markets. It's to buy things when they become cheap and sell those things when they become expensive. I'm more of a merchant in that regard, right? Real simple. And so I can look at certain high quality gold producing companies right now. They are hated by the market. Their prices are massively depressed relative to the last 2 and 3 years. However, some of them have exceptional management, and I would define exceptional management by a team of executives who have built and sold 2 or 3 companies in the past. So they've got a good blueprint, and success tends to beget more success. This is a very high risk business, and so I'm not opposed to betting on the rookie, but I prefer not to if I don't have to. And right now I don't have to. Right, I can bet on veterans who have come out with a handful of wins already. So I like that, right? And I always try to ask myself the question when I'm entering an equity position, when I'm buying shares in a company, what's my competitive advantage here? What do I know? Because it's a market. People don't think about investing as a market, but they should. If you're investing in Nvidia, for example, people just often pile in. They just buy shares on Robinhood or Wealthsimple or whatever, and they don't think about the fact that there's 2 sides to every transaction. And if you're buying something, that means somebody is selling that thing to you. And therefore, you're having a disagreement with somebody, right? If I'm buying shares in this company, we're looking at the same asset, right? A share in XYZ company, but we're making a different decision about the value of that share. I'm saying it's undervalued and going to go up. I think it's cheap. That's what I should be saying. And the seller is saying, I think it's overvalued and going to go down. So I want to sell it. And so I have to think really critically, what do I know that the seller doesn't? Like, what's my competitive advantage in this transaction? Because I'm squaring off with an adversary, essentially. And so when it comes to junior gold producers right now, I can ask that question and say, why is the seller selling when I think it's time to buy? And I can say with assurance that market was super hot in 2020, kind of spilled into 2021. A lot of new retail investors piled in on that hype. And then the market cooled off dramatically. And so there's a lot of shareholders that are sitting on these companies that saw, 40% drawdown from 2021 to 2022. but nobody wants to take a loss. So they're like, oh, I'll wait for the recovery. I'll sit on these shares and wait for the market to come back. They're down 40%. And now 2023, they're maybe down 70%. Suddenly it's scary, but they're like, I want to hang on, right? Now, however, we're seeing some pretty dramatic recessionary activity, like auto loan delinquencies going up, mortgage payments, pricing people out of their own homes, credit card debt hitting all-time highs, and credit card delinquencies climbing rapidly, new credit application rejections hitting all-time highs. So there's a whole bunch of factors in the mainstream economy right now that are squeezing people. Those people own shares in companies often. And if you're squeezed on your monthly budget, you're reaching out for new credit and you're getting rejected, you can't make your auto loan payment, you're looking for cash right now. And say you put 20 grand in XYZ gold mining company and it's only worth 4 today, you don't want to take that hit, but now you have to. You'll take that liquidity at any cost, right? And so they'll cash out, take the 70% loss because they need the 4 grand. That's my opportunity to walk in. It's predatory, but that's capitalism. And that's, I look for opportunities like that in the market. And there's a few where I'm seeing it right now.
So I wanted to get your thoughts on this trend we're seeing of global conflicts breaking out. Obviously, this latest one with Israel and Hamas is intensifying somewhat, although yet to draw players from elsewhere in the region into it, at least for the time being, although there is a lot of jawboning to the effect that the conflict certainly could expand. Do you think, we've got Sudan also experiencing a civil war. The list kind of goes on these days. Do you think any of this conflict is interconnected in any way? Is this, a lot of people are pointing to the fact that the world is bifurcating into an East versus West scenario geopolitically. Do you see the same thing occurring? Are these conflicts part of a pattern we could see emerge further? And what do you think the impact is on the commodity space specifically?
I definitely think it's part of a trajectory. So when these events occur, it's easy to look at them as isolated, independent territorial disputes. This, for example, Palestinian, Israeli, Hamas Israeli conflict goes on for literally thousands of years. Um, and you could isolate it and say, oh, that's its own thing. What's going on in Russia, Ukraine, it's kind of similar. Territorial dispute goes back hundreds of years. It's its own thing. We may see something in the South China Sea, whether China makes a move on the Philippines or more likely Taiwan. Similar, it's its own territorial dispute, it's its own thing. I don't see it that way. So a couple things there. I think that there's definitely hard lines being drawn between, call it the East and the West, just to simplify. And an interesting place to look for that, Jesse, would be after Russia invaded the Ukraine. The UN, they hold their votes, in house, and countries around the world vote on whether or not to condemn certain behavior or support certain behavior. And they host a vote every year on whether or not countries should condemn Russia's invasion of Ukraine. They did this in 2022 and in 2023. And the way that vote was split was about 141 countries around the world condemned the invasion, and something like 38 or so voted to abstain, they abstained from the vote, or they voted not to condemn. And you could look at that as countries expressing their opinion on that specific conflict. I interpret it as this is actually a proxy vote for countries who are pledging their allegiance to the United States or to China. And you have still the majority of the world saying, we're going to stick with the largest economy in the world, right? Or we're tied in there for better or for worse. But there's 38. And I think out of that 38, 32 abstained. So there's a handful that just said, no, we're with Russia. But there was a decent number of large countries, some of them, who abstained and just said, we're not quite ready to call it yet. We're not quite ready to throw our hat in with the United States or with China here. We're going to wait and see how this unfolds. We're going to let you wine and dine us a little bit, what kind of trade deals are on the table, et cetera. But that is how that vote was a proxy vote, in my opinion, for that East versus West allegiance. And I do think that's the way that the world is evolving this decade. I think that's the story we're watching unfold. That's the narrative, right? That's playing out in front of us right now. And Russia's invasion of Ukraine stresses the global superpower. Hamas invasion of Israel, and maybe subsequently we'll see what happens in Lebanon. But I think this is going to escalate. I think it will become a broader war and will stress the United States even more in their ability to continue to support these proxy wars. I know President Xi was just in Taiwan, and the rumor is he's putting together a deal that says if we show up on the shore, you will not resist. It'd be challenging for the United States to defend Taiwan if Taiwan is not defending itself. That's kind of the speculation about what's going on there. But essentially, you're seeing these little wars picking off little chunks of United States, proxy supporting countries. They're taking their shot at the global superpower, which is what you see during the sunset years of an empire every single time. We touched on a handful of these empires in the past, Portugal, Spain, Holland, Britain, and now the United States. When these empires come to their sunset years, you typically see three things begin to emerge. And the first is just the insolvency of the state, right? You began to get over your skis in terms of entitlements and spending and generally supporting military activity all over the world. That's a big one for all those empires. And you have to start expanding the money supply to paper over those losses. And obviously that's front and center right now. And then secondly, you see internal conflict arise within the country that begins to border on civil war, usually in response to increasing wealth gaps among that population. People don't understand why they feel a lot poorer than their neighbor. So they find an enemy and they try to incriminate that enemy, even if it's the wrong enemy. But you see that emerge in the form of civil unrest. And obviously, we're seeing a ton of that inside the United States as well. But the third element is that rising external competitive power and the challenges the superpower for global trade share. And, obviously, we're seeing that as well right now. And so this activity is it's very predictable, I would say, in terms of if you look at the blueprint that every previous empire within written history has followed, these steps are very standard. It's very standard behavior. And so, yeah, I think that we're watching this transition occur right now. I wouldn't go as far as to say that, inside of the decade, US dollar is going to lose reserve currency status. I don't think it's that dramatic. I think these things can be kicked a lot further down the road than we imagine. That's been proven already. How do you get to $32 trillion in debt, by the way, right? You got to hit 10 trillion first and 20 trillion and 25. You don't just end up. So it's been unsustainable and crazy for a long time, but we've continued to push this can further and further than anybody thought we could. We'll do that some more, I believe. But, all of this, you asked about the commodity sector. What it points to for me is we were in the era of global trust. Fragile as it might have been for my entire life, it was the era of increasing globalization. And if you had the cash or the credit, you could buy whatever you wanted from the global marketplace. Well, these lines are now being drawn, as we just discussed. And as a consequence of those lines being drawn, countries are going to be a lot more protective with the raw materials they have. Back to my initial thesis about how I try to understand the world, right? It's understanding how humans are with the materials they have. And that dictates a lot. And we're seeing this behavior right now. We're seeing countries so the United States weaponize their currency. Well, that's because they have the world reserve currency. Russia's currency isn't the ruble, it's energy, right? That's their true currency. And they've weaponized that in response, right? And brokered specific deals to cut certain countries off or curry favor. They'll be selling gas this winter to China for 50% the cost they'll be selling to Europe, for example. I mean, if your country's in tough financial shape, getting a 50% break in your energy bill is a huge boon. So deals like this are occurring, and all that means for me is that if the supply of the raw materials you used to have access to is now compromised, meaning you thought you were going to get your nickel from here and your copper from there and your cobalt from there, and your gas from there, but now that era of trust and globalization is over, your security over that supply is suddenly uncertain. And when the supply of something you need becomes uncertain, the value of that thing goes up, usually quite a lot. So that's my high level thesis on the commodity sector this decade, is that in response to the breaking up of globalization and global trust, the supply of everything is less certain, increase in the value. And I think that commodities are a great place to be this decade as a consequence.
Yeah, I completely agree with you there. And interesting comments about the weaponization of energy. I live in Serbia, and one of the many reasons I do is because they're allied with Russia and so have free access to Russia's energy. People can hate on me in the comments if they'd like to. But I wanted to continue along that trend of weaponizing commodities because China has recently increased export controls on graphite, in addition to restricting gallium and germanium exports, which are rare earth elements critical to computer chips. Now, according to Benchmark Mineral Intelligence, China controlled 58% of the global production of lithium compounds in 2022, 69% of nickel sulfate, 69% of synthetic graphite, 75% of cobalt, 95% of manganese, and 100% of spherical graphite. So, do you think we could see more of these export controls out of China and other countries as a sort of resource war to be used against political opponents?
Yes, 100%, 100%. And a lot of people realize this. For sure. I mean, look at the chart of a company like Northern Graphite, right? One of North America's first graphite producers over the last couple of years. It's no shocker why suddenly that company is very, very important. You just mentioned it, right? And it's been unsustainable and silly that the United States would borrow money from China to buy ingredients produced in China and have weapons manufactured in China to defend countries against China. Like none of this makes any logical sense at all. But that's the scenario that we ended up in after 40 years of globalization. So that's breaking now for sure. And yeah, countries are realizing what aces do we have up our sleeve. Russia's got energy. United States has the US dollar. Indonesia, largest nickel exporter in the world, right? Largest nickel exporter in the world. And that's the ace up their sleeve. And they last year put a ban on nickel export. Now, they're still exporting processed nickel, but historically they would export raw nickel. It's very cheap. They realize they're missing out on a big chunk of the revenue they could generate from owning more of the supply chain. So now they banned the export of raw nickel. They built processing plants. They're processing in country and exporting the processed nickel to the tune of a 30x increase in their nickel revenues. But their increase in revenue comes at somebody else's expense. And so in response to that, all sorts of hostilities have broken out. And, the United States, Europe, and China have all approached the World Trade Organization complaining that Indonesia shouldn't be allowed to do this, But that's the ace up their sleeve. And by the way, that's coming down the pipe from Indo with copper and cobalt as well. And so, yeah, 100%. Back to that core concept that the supply of everything's a little bit uncertain. Therefore, the value is going to go up. If the value of something goes up, you become more strategic and protective over that thing. And so, yes, whatever minerals you're producing that the rest of the world doesn't have access to, that's huge leverage. It's very important leverage. And back to like the distribution of power typically follows the distribution of the raw materials that are important during that era. That's how you follow, the threads that will help predict the future. And those materials change over time, right? Like you go back, 400 years, 500 years, we fought wars over nutmeg, and salt and rubber, weird things, bananas. We went to war over bananas in the late 18th century, early 19th century. United States went to war in Honduras, Cuba, Nicaragua, El Salvador, killed tens of thousands of people to protect the interests of the United Fruit Company. So it was the same thing. We think about, commodity wars. We think about oil. Oh, countries go to war over oil, right? Not over nickel, right? Would somebody invade Indonesia for nickel? Nah, we go to war for oil. It's like, yeah, recently, but in the past, we've gone to war for tobacco. So, I mean, it can shift. And President Widodo in Indonesia is very aware of this, by the way. Like he's come out and said, this is risky, but in his words, we have to dare to take these steps because he realizes now is their time, right? To play the hand that they've got. This is the ace. It's time to play it because the geopolitical chessboard is being shaken up. And if you hold the materials the world needs, that's your power, right? So now is the time to leverage it and play your role. So I expect a lot more of that, Jesse, a lot more in the coming years.
We've seen massive protests in Panama recently, in many ways bringing the country to a standstill. And this is all due to First Quantum's copper mine there, causing the government to reconsider allowing it to operate as originally promised. Mexico's banning new open pit mines. The Portuguese prime minister resigning now over a corruption probe involving lithium projects and other raw materials. The coup in Niger that happened recently that's putting uranium production there at risk. It seems like jurisdictional risk is heating up. So I'm wondering how you personally view and mitigate jurisdictional risk in your own portfolio.
Yeah, it's really hard and it's going to get harder. And some of the things you just mentioned there, they get back to during the sunset years of an empire, as we discussed, you see an increasing wealth gap, right? And as the wealth gap increases in the global superpower, it usually is amplified in developing nations around the world. They usually get the brunt of it actually in the global superpower. You're the tallest building's the last one to fall, or some stupid analogy like that. But that is the case. And other countries get the brunt of it first. And in response to increasing wealth gap and inequality, people get really angry and they don't know who to be angry at. And so they start finding enemies and attacking, right? And you can find all kinds of ways that this manifests in society today, but one of which is to point the finger at corporations who make money, right? And you could say, oh, the mining industry makes a pile of money. This is unfair. They should be sharing that money with us because we're the citizens of this country. And that is a very repeated argument that occurs time and time again and is occurring right now in many countries around the world, as you just discussed. And so, yeah, that occurs sometimes in response to populism, where percent of the population rises up and says those profits should be shared with us, whether or not we contributed to the productivity of that business or industry. We deserve a share, right? Because this is unfair. I shouldn't be poor and they shouldn't be rich. We should be equal. Okay, so that's like a big thing that occurs and is occurring right now, and I think will continue to escalate. The second is, back to that, if you are confused about why you feel left behind, you will find an enemy and incriminate that enemy. Obviously the fossil fuel sector is getting massively attacked over the last 15 years, leave it in the ground, renewable energy transition, all this stuff. And people don't think about how that's going to work. If you want to transition the world off of fossil fuels, I think that's a great idea, but you need to build the infrastructure that is required to actually power the world off a new energy source. Call it solar, whatever you want. Pick your vehicle. In order to do that, you need a whole bunch of ingredients that we don't have right now. We need a ton of copper, a ton of nickel, a ton of lithium, a ton of cobalt, a ton of graphite, all this stuff to build the batteries and the solar infrastructure, a lot of silver, to build whatever kind of infrastructure for the chosen source of energy. We don't have that now for a couple of reasons. Number one, there's been huge protests against pulling anything out of the ground. Any extraction industry has been vilified. And so sentiment has been opposed to any capital allocation in that direction. As a consequence, we've invested very little in the production of new resources. So we don't have very many. So, it's just like a misunderstanding of how we're going to move the world forward. And secondly, because, money's been so cheap and speculative growth stocks have done so well, why would you look for value in the raw material sector? So it's been starved of cash for a long time. So there's this massive supply deficit. But I think that those two factors play the biggest role. So back to Indonesia, one bullish statement I would make about President Widodo in Indonesia is he's not doing that. He's not nationalizing mines. He's not imposing super taxes on the export of materials. He's not penalizing foreign direct investment, which is the usual case. I mean, that's what you're seeing in Panama. That's why First Quantum has crashed. What he's doing is he's just trying to own a larger percent of the supply chain, which is intelligent and actually encourages foreign direct investment in that country. And so you have to look at the policy decisions coming out of these countries to determine jurisdictional risk. And so, yeah, I wouldn't touch Panama right now for the reasons you just discussed. Am I curious about Indo? Yeah, and that tide could shift quickly, right? Elections happen very frequently in every country, most of the time, and policy trails that. And so, you can be in a good location that switches quickly. But I would say, it's more important than it used to be. Geopolitical, jurisdictional risk, far more important than it used to be. And there's no real hacks to that. You could look at what countries are maybe allied with the West and say, oh, they're more likely to have predictable, safe governance. Maybe not. You could find examples of that being very true and examples of it not being true. So I don't think there's any hacks like that. I think you do have to look at each country independently, look at their track record and how they favor certain industries, look at where the GDP is produced, and are they heavily reliant on certain industries that they're therefore far less likely to compromise? Well, sometimes they'll do it anyways. You got to be careful, but it is a case by case basis and a very, very important one.
So you recently released an online course for people new to the commodity space called Commodity University. I wonder if you could touch on some of the main factors you think people who are new to the commodity space should be paying attention to. What are the main things in your view?
Yeah, certainly. So yeah, we launched the Commodity University about a month ago. I believe that commodities will provide a wealth creation opportunity this decade that is a once in a generation thing. And so we launched the Commodity University to help anybody who has no experience understand the fundamentals. And we really, as you know, we paired it back to like the absolute basics. Chapter 1 literally is what is a commodity. Chapter 10 is portfolio construction, and the middle is all kinds of things like risk management, economic indicators, supply and demand dynamics. We do deep dives into a handful of commodities themselves. But I a few things, Jesse, would be first of all, um, there's a handful of vehicles available to investors who want to allocate cash to the commodity sector. And what matters most about how you select those vehicles, and when I say vehicles, I mean you could buy, let's take gold or copper as two examples. In both cases, you can just buy the physical commodity. In gold, that kind of makes sense. In copper, it doesn't really, just because of the mass you would have to acquire to store wealth there. There's upsides and downsides to that specific vehicle, right? It's less volatile, so you don't really achieve many capital gains. It doesn't pay a dividend, so there's no cash flow, et cetera. But it's pretty stable. You own the assets. There's no counterparty risk, so it's quite secure. You could look at like an ETF or a managed product of some kind, more passive style, which is how I recommend most investors enter the space, because it'll give you a bit of skin in the game, which is really important. So you'll be emotionally attached to the outcome, which is very important to begin to build that resilience to price volatility. Everybody thinks they're a genius when prices are going up, and they get terrified when prices are going down, but that's normal. And it's not inherent that humans are just okay with that experience. And so dipping your toe in the water with some passive vehicles is smart, and limits your risk exposure. And so understanding the vehicle that's right for you. I mean, I kind of live this, right? So I invest in the actual stocks themselves, and I buy shares in the companies that are producing these commodities or exploring for them in the super speculative realm. But it's because I kind of, eat, sleep, and breathe this, right? And so I'm okay with that higher risk profile vehicle. And in exchange for taking on that higher risk, I have the possibility of a much higher capital gain outcome, right? Possibility, right? And so, stepping back, any investor should do this, by the way, not just commodity investors, but you should always step back and say, what kind of investor am I, right? Am I looking for the super speculative, high risk, high return opportunity? Can I stomach that, right? Financially or emotionally? Do I want to contribute capital over a couple of decades very passively and thoughtlessly? And, I'm comfortable in the commodities thesis for probably the next decade, so I don't want to think too much else about it. Maybe for the next 5 years, I just want a dollar cost average in to get exposure to the industry as a whole. You look at products that facilitate that. There are many, and pros and cons to that as well, and different risk factors that should be understood. There's counterparty risk there, of course, right? Like someone's managing that product. And then the physical. See, you find out like, how much time do I have to invest in being an investor? And that'll tell you a lot about what kind of investor you are, because if you have half an hour a week, you shouldn't be picking stocks. That's for sure. You need way more time to do proper diligence. And so by determining how much time you have to invest, you can determine what kind of investor you should be by thinking about things like, what's my time horizon? Am I investing to be, because here's the thing, I'll just say this, man, it's easy to get rich, Jesse, if you have patience and discipline. Most people don't. But if you have patience and discipline, getting rich is quite easy. Patience means it's going to take you a long time, though. And most people want to get rich tomorrow, right? And so, but if you can step back and say, I'm investing for my 50s, and right now I'm in my 30s. Well, that's really important. That's a really important data point, because it'll determine a lot of how you allocate capital. It'll determine a lot about how you interpret price volatility, right? Because there's two things that happen in a market, like in a bull market. Let's say I'm right about the commodity super cycle we're in right now. Well, there's two factors that are going to influence price at a high level. One is the macro supply and demand. This is like, we need a ton of copper. We don't have much. So the price of that thing is going to go up over the next decade. And I'm quite confident in that statement. But in between now and 10 years down the road, there's going to be massive volatility in the copper price, because there's not just long-term value investors like me that are playing. There's also short-term traders that are playing. And they overbuy and they oversell, and they overbuy and they oversell, and they're in and out and in and out. And so that's what causes these like short-term rallies and busts over the course of a long-term bull market cycle, because there's two players playing with the same puck, And so if you're clear on your time horizon, you can say, well, I'm investing for my 50s, then I don't really care what happens this quarter or inside of 9 months or inside of a year even, because I'm not hitting the bid for another, I'm here for the long term. And so that's like maybe the most important thing is getting really clear on your time horizon, because that'll tell you what kind of investor you are. And then it helps you manage the volatility and the risk and step back from the noise, just focus on the signal. And so it's a core thing that we help people focus on. For anybody who's interested, it's thecommodityuniversity.com. Really easy to find, and I love it.
Awesome. Well, Jay, it's been an amazing conversation. Learned a ton chatting today. I will put a link to the Commodity University in the description for people who want to check that out, as well as a link to the Jay Martin Show. You got a great program there as well. So it's been a pleasure, buddy.
Pleasure's all mine, Jesse. I appreciate it, man.
And thank you for joining us today. As a reminder, this episode is brought to you by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.